Hi, I'm Nick from Coin and Paper, and today I want to talk about interest, which is an interesting topic. So, interest, there's two ways of looking at it, or there's two positions on interest. One is if you are a borrower, or two is if you are a lender. So, if you are a borrower, you're paying interest, and if you're a lender, then you are receiving interest. So, one example is if you have a savings account at your bank. A lot of savings account pay a little bit of interest, some more than the others, and there's if you put more money in and for longer periods, things like that. But if you put money in a savings account, generally you should be receiving a little bit of interest on your account. So the bank actually pays you that little bit of interest because they want to encourage you to deposit money with them, and then in turn, the way that they pay you that is they actually take your money and they borrow it out to other borrowers. And so with that ability, they charge interest on those who borrow that money and in return pay you a little bit of it. So with that said, the banks, when they loan out that money, they can loan it out in different ways. So one of the main ways they loan out is through loans. So some loans that you're familiar with is mortgages, and that's a loan for your house. So mortgages have like a 5% interest rate or around that amount. And that's generally, like for you, if you want to buy a house, you're going to pay interest on the mortgage if you have a mortgage. And that's usually a large amount of money just because mortgages in general, you're borrowing a lot of money to buy a house. So you'll be paying a lot of interest over the long run. Also, businesses take out loans and they pay interest on that amount. Another way for you to think about our interest as far as being the lender, if you buy bonds, because we talked about in one video investments, and you can invest by buying bonds or buying stocks. So bonds is you letting, for example, the government borrow your money so that they can spend it on things that they need to spend the money on, and you in return are getting an interest rate. So some bonds, some long-term bonds or treasuries they call it too, could be 30-year bonds or 10 years, or even have shorter periods like less than 1 year. But if you want to earn interest, then you can leave it in a bank, you can put it, or you can buy bonds. So more talking about the other side of interest when you're paying for it as the borrower. So we talked about the mortgages and we talked about the business loans, but also there's credit cards. So for credit cards, that's usually a big place where people spend a lot of money on interest, and that's because with credit cards, the interest rate is super high. It's like 300% higher than a mortgage rate, for example. So mortgage might be around 5%. Regular credit card could be about 20%. So 20% is very high. So of course, you don't want to have a high balance on your credit cards, otherwise you're going to pay a lot of money. And there's a different thing between the two different loan types, that is a mortgage and a credit card. Credit cards are what they call variable loans, or because it could constantly fluctuate. So basically with them, credit cards give you a credit limit, and each month you can use it or not use it and then close that amount. So you can carry a balance or you can close it and just have that available where you're not paying anything. Whereas with mortgages, that's a fixed loan, just like car loans as well, those are fixed loans. So you know exactly how much you borrow and you get that full amount at the beginning, and then it's your job to pay it back over a fixed amount of time, which for a typical loan for a mortgage, it could be 30 years, or a car loan, maybe the average is about 5 years. So those are two different loan types, and you see that the credit card, the revolving credit, a variable one, usually has a much higher rate. And some tips on the credit card. So usually people carry debt, and that means instead of when they use it this month, their credit card, and say if they spend $1,000 on the credit card, if you don't pay that amount by the end of the month, then it's going to carry over, and that's when you pay interest. So the goal would be then, of course, if you can pay off your credit card, pay off the full amount every month, and then you won't have to pay any interest. So that's the best thing. And so some tips on the credit card. A lot of credit cards today have different, we'll say perks or benefits, and a lot of them that you see today are cash back. Sometimes they have frequent flyer miles or points towards a favorite store of yours, but with cash back or any of those really, when you spend money on your credit card, you actually build up points. So the best position would be pay off your credit card, put all your regular expenses on your credit card, but as long as you can pay it back at the end of the month, and you'll actually make money in either interest, it's like kind of an interest, the rewards, so the credit card is actually paying you to use it. So that's a tip, so that would be the goal, of course. Rather than paying interest, the best thing is to be paid interest. So being a lender versus a borrower is always the best way to go. So I hope you learned some interesting facts about interest, and I'll talk to you next time.